Hello and welcome to this session in which we will discuss the reconciliation of the sales subledger to the general ledger. Now, for a topic, this is an easy topic to understand. However, most likely this topic you might see in a form of a CPA exam simulation. In other words, it's easy to know what reconciling is. I'm going to explain what a sales ledger is. I'm going to explain what a ledger is. I'm going to explain the purpose of reconciling a sales ledger to a general ledger. I'm going to show you an example. I'm going to show you some reasons why there could be a discrepancy between the two. Nevertheless, you have to be comfortable on the exam day if you got a CPA exam simulation to be confident that you understand the concept and be able to reconcile or find the discrepancy between the two. So what is reconciliation of the sales ledger to the general ledger? Well, it's a process in accounting aimed to make sure the accounting information is accurate and consistent between those two financial records. And the two financial records are the sales ledger and the general ledger. Every time you hear the word reconciliation, so we are reconciling. What do we mean by reconciling? Reconciliation means you are comparing two things, one to something else. Where did you heard this topic before? Well, when we prepared the bank reconciliation, we looked at our bank account, then we looked at our cash ledger, and we reconcile the two. So every time there's a reconciliation, it means you are working with two records, making sure everything on one record is also on the other record. So we are accounting for everything for the purpose of consistency and accuracy. In this session specifically, we're going to be preparing the sales reconciliation, sales subledger to the general ledger. So the purpose to summarize: accuracy. Ensure that the total in the sales ledger matches the sales account general ledger. And we're going to explain what a subledger and a general ledger in a moment. To identify any errors, and that's the main purpose, is to make sure if there's any discrepancy, any errors, or most importantly, reconciliation would reveal any fraudulent activity where sales is being recorded on one books and not on the other. And in compliance, you want to make sure compliance with accounting standard and internal control. Part of your internal control is to reconcile the sales ledger with the general ledger. All in all, it helps maintain the integrity of the financial record, which is crucial for decision-making, reporting, and compliance purposes. If you have the wrong numbers, well, you don't have financial integrity. The people are making decisions based on the wrong numbers. So let's start by understanding what is a sales ledger and what is the general ledger. Now we understand the overall big picture. Before we proceed any further, I have a public announcement about my company, Subledgers.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
I'm going to give you this picture here, if you can see it here, to kind of explain this concept. So let's start with the sales subledger. The sales subledger, specifically for account receivable, because we are dealing with sale, it contains detailed information about each sales transaction, including the customer details, invoice amounts, date, and payment status. So what would it look like? So we keep track of each customer separately. So this is customer 1. I'm going to identify it as customer 1. This is customer 2. Well, let's call them customer A, customer B, and customer C. We have 3 customers. Now each of these customers, we're going to have their name, their address, how much did they purchase from us, how much did they pay, how much do they still owe us. So for the sake of simplicity, I'm only going to keep track of their receivables. So for example, customer A owes us right now $500. Customer B owes us $1,000, and customer C owes us $750. So those are the balance of account receivable, customer A, B, and C. So customer A is what's called the subledger or an account receivable or sales subledger. B, same thing, 3 customers. Now, when we add those customers up, because when we look at our balance sheet, we see one account receivable. And that receivable is the general ledger. So we see the general ledger account receivable. Now the general ledger account receivable would include customer A, customer B, and customer C. Therefore, if this is the general ledger, what should be the balance if this is the general ledger for account receivable? It should have all three balances, which is 2,250. So the account receivable ledger is 2,250. Let me show it to you from a T account perspective. So we could have three T accounts: account receivable for customer A, account receivable for customer B. I'm showing you the same thing, just in a different format. Customer C, we have 500 balance, 1,000 balance, and 750. Now we also have an account receivable general ledger, and this account receivable would include all of them, which is 2,250. So this is basically the subledger versus the general ledger. So the general ledger is the primary accounting record for the company. It summarizes the financial transaction across all the accounts, including the total sales, the total receivable, whatever we are doing here. But here we are dealing with sales or account receivable. So what are the steps in the reconciliation process? Well, first you gather record, collect the sales subledgers report and the general ledger sales account statement for the period. Take a look at them all. Verify the total. Compare the total sales amount and the subledger with the total sales of the general ledger. Again, you can do the sales. You can do, if you're dealing with account receivable, you can deal with account receivable if you're only dealing with sales on credit. That's why I'm using the word sales and account receivable interchangeably. And those two should match. Those two means the subledger and the ledger if we're dealing with sales. So simply put, we also have a sales general ledger, and for every customer we have the sales record. But remember, the sales is a credit record if we're looking at sales. So we add up all the sales subledger, they will add up to the sales general ledger. And what you're looking for, don't worry, we're going to look at an example if just this is not making sense yet. You investigate any discrepancy. If there is a mismatch, investigate each entry to find the error or the omission. This may involve checking individual invoices, sales receipts, or journal entries. Then if there's any discrepancy, you make the necessary adjustment in the ledger to rectify any identified discrepancy. This might include missing transaction or correcting errors. We're going to look at some reasons why this could happen. Then keep a record of the reconciliation process, including any discrepancy found and actions taken to resolve it. And on a regular basis, perform this reconciliation to maintain the integrity, the accuracy of the financial records. Now, why would there be a discrepancy? I'm going to list 10 common reasons for discrepancies. Those are not the only 10, but those are the most common 10 reasons. Actually, if you have a computerized system that's integrated, you can cut those reasons into maybe 2 or 3 reasons. You could have 1 or 2 reasons why you have discrepancy, but I'm going to assume you might be using a manual system. One is data entry errors. Mistakes made during manual data entry. It's assuming you are making manual data entry. In other words, if you are updating the account receivable and the customer record manually, well, you might make a mistake. For example, an invoice could be entered with the wrong amount or not entered at all. So the customer purchased $1,000, you might enter it in the record as 500 or some other number. Well, if you are doing this manually, this could happen, and as a result, there could be a discrepancy between the two. Timing differences. Transaction might be recorded in the sales ledger, again sales or account receivable, on one date, and in the general ledger on another date. This is especially common near the end of the reporting period. However, if you are using a computerized system like QuickBooks, simple accounting software, once you record your sales, it would record it in the subledger and the general ledger instantaneously. But if you are using a manual, you are updating these manually, then you could have a timing difference, and as a result, you could have a discrepancy. Omitted transaction. Again, this problem should not happen. A transaction is recorded in the sale ledger, but accidentally omitted from the ledger, or the opposite. It's recorded in the subledger, not recorded in the general ledger. This is often the result of oversight or miscommunication. Again, if you're using a computerized system that's updating both at the same time, there will be no problem. Duplicate entries. A transaction might be recorded more than once in either ledger, leading to inflated total. You have to look for that and reverse it out. Incorrect account posting. A transaction could be incorrectly posted to a different account in the general ledger, leading to a mismatch in the specific sales. So you recorded it somewhere else. Adjustments and reversal. Adjustments or reversal entries in the general ledger for returned goods, discounts, or allowances may not be mirrored in the ledger. So a customer returned the item, you updated their account, you reduced their account receivable specific or their account sales, but you did not update the general ledger. Whether it's a return, you gave them a discount or an allowance. So it's updated in one place, not the other. And the problem here is fraudulent activity. In rare cases, discrepancies might be due to fraudulent activity where transactions are deliberately altered or omitted. For example, if a manager wants to inflate sales, they might increase the general ledger without creating a customer. Because if you create a customer, the customer will have a name, address, social security, so on and so forth. And it's a fraudulent sale, so you'll try to dump it into the ledger, but if you do the reconciliation, you'll see that there's no customer exists for that sale. It could be a system error. If the company uses automated accounting system, it could be a glitch or a software error that could cause the discrepancy, and this could be a major problem. You need to fix the system, because remember, computers work great. They're consistent, so if they're making a mistake, they will make this mistake consistently. Another reason for this error could be exchange rate fluctuation, especially if you are selling and receiving money in foreign currencies. Exchange rate fluctuation, where you recorded the amount in the ledger, in the subledger, differently than the general ledger, because the exchange rate differences that will create a difference as well. You could also have rounding differences. Minor discrepancies can also arise from rounding off amount in one ledger and not in the other. Could happen as well. Best practices in dealing with this: automate the process. Most of the problems that we looked at, most of them are resolved if you're using accounting software that's updating both at the same time and preparing the reconciliation for you. Regular review. Conduct reconciliation on a regular basis to avoid buildup of discrepancies. Also, ensure your staff, your people, are well trained. You have a good internal control system to reduce those errors. Now I'm going to look at a simple example. Although this is really a simple example, it's very, very important to understand the big picture through that example. So let's assume we have a sales ledger. Again, when we say sales, if it's sales on account, it's the same as account receivable. Transaction 1, we sold the customer A for $1,000 worth of merchandise, customer B $500, customer 3 $300, or transaction 3 for customer C, and transaction 4 for customer D. So the total sales according to the subledger. So if someone might ask you, go ahead and update, add up or sum or foot all the sales subledger. You foot them and they add up to $2,000. You look at the general ledger sales account, assuming we're looking at the sales account, and the sales shows a total of $1,800 for the same period. Obviously, something is wrong, because if I add up all my sales individually from all the customers, then I compare this to the general ledger sales account for the same period, I see there's a discrepancy of $200. And this is what you are looking at. You are looking for discrepancies. So, initial comparison shows a discrepancy of $200. You investigate this discrepancy. You would review each entry in the subledger and compare it against what's recorded in the ledger. So you would say something like this. Customer A, $1,000, it's there. Customer B, $500 is there. Customer C, $300 is there. Most likely this transaction was not recorded, but this is what you will do. Again, this is time consuming if you are using a manual system. It's discovered that the sale to customer D was not recorded in the general ledger. What do you do now? You go ahead and you make an adjustment. Record the missing transaction of $200 in the ledger. Then you revise your total. Initial $1,800. The adjustment added the $200. Your revised total is $2,000. Final verification. Subledger equal to $2,000. Revised general ledger equal to $2,000. Reconciliation completed. We are all happy. Both ledgers now match. Now I'm going to show you here a ledger or a sample of a ledger from the real world to give you an idea. This is an accounting information system, but this could take the form of many. This picture could take the form of many other presentations. But here's the sales journal. Here's the sales journal. On February 2nd, we sold to Henry, invoice number 307. $450 worth of goods. Now we debited account receivable, credited sales, debited cost of goods sold, credited inventory. Now what do we have to do? For this customer, there is a, for Jason, there is a, notice here for Jason, there is a subledger. So Jason, February 2nd, we debited his account receivable $450. So this is a subledger $450. Now we updated his subledger. Let's go to another transaction for Jason that took place on February 22nd. We sold Jason 225 worth of goods, and those had a cost of $155. Notice what we did? We also updated the subledger for Jason. So Jason prior to February 22nd owes us $450. Then we added another $225. Now Jason's balance is $675. So I'm showing you how the subledger works. And you could go ahead and for every customer, Albert, Cam, Paul, we have a subledger for each one of them. Also, what we do is we keep track of the account receivable general ledger. The account receivable general ledger is the total for all. So for this period, if we add up all the receivables, it's $2150. Then we will have, as of February 28th, $2150 as a total. We debit account receivable and the balance is $2150. So when we add up all the individual balances equal to the subledgers. So those are the client, the T accounts of the clients. And if we look at their balances and we add them up, they should add up to $2150, assuming all the customers are listed here. It should add up to $2150. Okay, so this is the sub and this is the general ledger. This is for account receivable. We'll do the same thing for inventory. What we did here is we credited inventory in total 1,500. So simply put, the sales journal, is basically, it's rather than debiting account receivable, crediting sales, debit cost of goods sold, credit inventory, for example, for Jason, 450, 450, 315, and 315. So this is I'm showing you one entry for this. But here, the journal is making it easier, debit account receivable, credit sales, which is this one here. I'm showing it to you also in a journal, what it looks like in a traditional journal entry. Again, different accounting information system will show this differently, but the point remained the same. Now we have to reduce inventory. Prior, we had 15,700. After the month ended, we update our inventory. Now it's 14,200. This is the general ledger for inventory. Now keep in mind too, we could have a general ledger for the inventory. We could have many types of inventory, and we could keep in track of each type of inventory separately. Parts 6, 7, part 8, 2, like, different parts. And for each one, and if we add them all up, they will add up to 14,200, just like we have a subledger for account receivable. I just want to make sure you're aware of this. Notice here sales. We add up all the sales, they would add up to 2,150. Cost of goods sold, same thing. We have a general ledger for cost of goods sold. The point I'm trying to make here, it's easy to know what a general ledger, or I hope it's easy to know. It's easy to know what a subledger. I explained that to you. It's easy to know what is the reconciliation process. Your job on the exam day, if you are giving a CPA exam simulation, if you are given multiple choice, this should be easy multiple choice. However, if you are giving a simulation, breathe, slow down. Most likely you are looking for a discrepancy. Look for that discrepancy. Something is missing. It's either here, not here, or it's not here. It's something is missing. Just study hard, understand this concept better, invest in yourself. Good luck, and of course, stay safe.